Jeff, welcome. Jeff, how would you describe the current state of private equity and what feels to you, I suppose, meaningfully different now?
Yeah, well, I think it's been a couple of challenging years for the private equity industry. We've seen rates of return on portfolios come down over the last couple of years. We've seen a lower level of distributions coming off portfolios over the last few years. And of course, that's had a dampening effect on fundraising. And I think there's a lot of drivers of that. I think the big one is the hangover of high prices that were paid during 21 and 22, and we're still kind of growing into those valuations as an industry. And I think there's been a lot of macro challenges that have come along the way as well. So there's a lot of issues out there and concerns. But I think the way forward here is, one, I think prices need to adjust. And we've seen some prices come down and valuations come down in the market. And I think what's going to be paramount going forward is really value creation strategies on the part of managers. And managers continue to develop those value creation capabilities inside their firms. And the emergence of AI will be another component of that going forward. And I think it's ultimately about being in the right tailwinds sectors, the right subsectors of the market. And that's why we really like the mid-market. You can pick those subsectors, those niche part of the markets where you can get multiples of GDP growth.
What's fueling the growth of the secondary markets and how is that impacting, I guess, how investors are thinking about things like portfolio management and all of that?
Yeah, so the secondary market had a record volume year last year, and I would say it's part structural and part cyclical. So the structural factors are most of this capital in the private market is organized around long-dated closed-end structures. And inevitably with those structures, investors at some point may need liquidity along the way. And so I think the growth of the private markets often means there's going to be growth in the secondary market. The secondary market's usually about 3% of the value of the primary market. But the cyclical factors have been very strong and topical over the last couple of years. And we've been really suffering from a level of distributions off portfolios that are as low as the GFC and longer than the GFC. And so the average age of assets inside portfolios is over 6 years. We've not seen it that long. So there's a big backup of liquidity in the market. And of course, secondaries is one of the primary tools that the industry uses to get that liquidity. I also would say the returns have performed well for investors. And so I think investors have been happy with the return experience of secondaries. Secondaries not only give you diversified, consistent returns, but also give you more near-term distributions. And you don't have that J-curve effect when you come into a fund fresh because you're stepping into existing companies that have been performing. And oftentimes you can do that at discount. So that helps the performance as well. And lastly, I would say the capital formation, even though the opportunity is big, I think the capital formation has been, not too much relative to the opportunity. So I think there's a good balance in terms of capital versus the investment opportunity that exists out in the market.
How do you expect that to change the trends going forward?
I think this liquidity problem is going to be a multi-year problem. So I don't think we're going to fix it this year or maybe even next year. So I think the backdrop for secondaries should be positive for a number of years here.
There's growing demand to make alternatives more accessible. How is the industry rising to meet that demand?
Yeah, this is very topical in terms of the democratization of private markets. And one of the themes I've picked up here at Milken is this idea around financial and economic mobility. And I think part of that is giving access to private market returns to the individual investor, the high net worth investor, ultimately the retail investor. So this is an exciting growth opportunity for the industry, of course. I would say that the near-term opportunity that people are focused on is really around private wealth. And private wealth investors have been coming into closed-end structures for a number of years now. But a lot of private wealth investors don't want the long lockups or can't handle the managing of the capital calls and the distribution. So it's a bit clunky for a lot of traditional individual investors. And so there's been a rise of semi-liquid structures and evergreen structures that really address that issue for investors. And these semi-liquid evergreen structures, and we've been an early adopter of these at Pantheon. We've had one for over a decade. They really allow the manager to really manage all of the cash flows going in and out and the recycling of the capital. And they give those investors a really easier point of access into the asset class. And so we've seen a lot of growing supply of semi-liquid funds and growing demand on the part of private wealth investors.
Jeff, thank you so much for your time.
Thank you.